Opportunistic investing is real estate's form of venture capital. It's really the most risk you can take as an investor. First, location. The location in opportunistic investing is much broader. You know, at Origin we cover 11 markets and we're really hyper-focused on specific submarkets within those cities that we believe provide liquidity and preservation of value. So in opportunistic investing, you can go to a tertiary city. And what I mean by that is a smaller city. But an opportunistic investor believes they're being paid for that unit of risk. In terms of vintage, you really can take buildings as old as they are because you're going to reinvent the entire building. I mean, if you're doing an opportunistic investment, it's very unlikely that you're not going to be investing a lot of capital into that building. And so if the building is 40, 50, 60 years old, that doesn't really matter because you're essentially rebuilding that building. In terms of cash flows, opportunistic investments aren't even looking at existing cash flows. Either they're empty buildings or perhaps they're a building that comes with a cash flow. But that cash flow is something that should be expiring because you're really looking at reinventing the building. So maybe there's a lease that comes with the building, but that's not why you bought it. You bought it because you believe you can do something to really increase value at some point during that hold. In terms of debt to equity, opportunistic investing really starts at 70% debt and goes all the way up to really 90 or 95% debt. As you move up into higher and higher debt levels, the expected return on equity exponentially increases. So that if you take a debt that's, say it's 50% debt, 50% equity, and then an opportunistic investment, you say, okay, I'm actually going to use 80% and 20% equity, the expected return shouldn't go up from 12 to 20. It's much more pronounced, and there are actual equations that you can use to quantify that yourself. The distribution of returns is going to be very large, as in any high-risk, high-return investment, whereas if you're talking about core plus, or value add, it should be a tighter distribution of returns. So the question becomes who should be doing opportunistic investing? And I would say that it's the confluence of the investor's own risk appetite. So if you in the public stock markets are really drawn towards high growth companies, early stage companies, that's a high risk, high return investment. Are those the types of investments that you consistently want to make? This is our venture capital, right? Opportunistic investing, both development and redevelopment of buildings where there's very little cash flows and construction risk and high debt to equity risk. That's the most risk you can take and the highest expected return you should demand as an investor.